Say goodbye to the age of disruption. For ages, startups funded by cheap venture capital money would come into a given industry and run circles around the existing players. But now that spigot has dried up, so the incumbents are winning, and that means their earnings could be better than anyone thinks. I think the lack of competition for these incumbents has been fueling a lot of the market's recent strength, especially in the NASDAQ. Even as today, it finished pretty flat. Dow advancing 101 points, S&P gaining 0.01%, and then actually edging down 0.03. But today was a bit of a roller coaster. As I watched the rebound from the bottom earlier in the session, it was once again kicked off by tech in a rally that began with the semiconductor company Micron and then broadened out to include pretty much every semi play, even as they had nothing to do with Micron. Hell, okay, look, it makes some sense. We haven't had a single new issuance in the semi world in ages. When you don't have any new IPOs, you don't have any new competition of any meaningful size, and without competition, the incumbents always win. Although the idea that the semiconductor capital equipment stocks could rally on an assured decline of orders from Samsung was quizzical and will most likely be repealed when the buyers come to their senses. You know, we've had practically no IPOs for ages. It's a truly seminal drought, not talked about enough. Something that was probably exacerbated by the collapse of Silicon Valley Bank, which often did business with startups and was very successful at it until its deposit base fled en masse. The vanishing of the new issue market means two things. Two things that are very positive for the stock market itself. First, the existing companies that are entrenched will no longer be challenged by smart, nimble new players because those new players are running out of cash and can't raise money easily because of the stock market. It's just not funding anything. We know this because part of the run on Silicon Valley Bank came from executives who were in a panic and borrowed against the shares of their not yet publicly traded startups. That's not normal, and it helped sink SVB just as it could sink First Republic. We got some disturbing compilations from Michael Semblis, one of my favorite strategists, in his Eye on the Market report from J.P. Morgan, pointing out that the impact of First Republic's unrealized securities and loan losses on its capital are so much worse than every other bank out there. So you can tell it was likely making those same risky loans against so-called pre-IPO stock, although this First Republic did have a nice little rally to the close. Live to play again? How about the second positive for the frozen IPO market? Just as it means there's no new competition for existing companies, it also means there's no new competition for your dollars, right? No new competition to their stocks, as investors usually cash in stock from incumbents to buy hot new issues. That's vital for the overall trajectory of the market. Money markets rates as excellent competition right now, and the new IPOs would take a lot of money away from the incumbents, but that is not happening. The incumbents are keeping the money. What's the longer-term impact of the first point, the lack of competition for the incumbents? Well, let's just look at a couple, okay? Let's look at a bunch of industries. First is fast food. McDonald's hit a new high today. It did so in part because of layoffs. If you lay off people in pretty much any industry these days and your sales are good, you're going to see your stock go higher. McDonald's is the ultimate example of the incumbent winning. See, ordinarily you expect a bunch of new fast food chains to come public when McDonald's is doing so well, which would compete against the Golden Arches. But consider the curious case of Sweet Green, a restaurant that could have been a contender if the market hadn't shut off its funding. This was a $5.7 billion company at one time, and still a $3.1 billion company at this time last year, but the time it should have been using to sell more stock is over. Unfortunately, it did so. It didn't. It stumbled. So now the company's only worth $1 billion. That's very good news for every other incumbent fast food company in the industry, including McDonald's. Gives them more breathing room. Maybe the precedent set by Sweet Green wrecked things for a dozen other new restaurant chains that might have been waiting in the wings to go public. They became persona non grata because of Sweet Greens and all the money it lost you. Long live the incumbents.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.